Finally figured out why. Because you know I work on that stuff right now. Oh, KYD, right?
Yes.
So I have those.
Where was I gonna find that out?
Bro, I don't know.
And I
But you
can
should come
actually
visit me because I
move
work
the camera a little
like
bit so you get a
like
little
one more
more
week.
of that.
Oh, actually,
No, I did. No, maybe not. I think I did one time. Have you had Rivers ice cream? Hey, look, if you come visit me, I will give you my free ice cream flash shift. I'm not even kidding. It's so good. It's my favorite ice cream. I need someone to like fangirl about it, you know? I work Friday. Like Friday. So like next Tuesday. Yeah, next Tuesday. Anyway.
All right, let's get started, guys. Welcome to those on Zoom and those here in person. So this is our final point training of the preseason. So let's give us a hand for getting sales season. We have about it's probably about 25 reps out selling right now. We've had reps already hit their 18-week sales club, their 12-week, 5-day. I think we had a 7-day already. So like we're balling. So great job to the guys out in the field. You're not probably seeing this right now, especially if you're in Oregon or Washington because you're selling, because you're knocking doors right now. But you'll watch this later. So the rest of you will be selling in the next month. Some of you in the next 7 to 10 days. And so this is our last thing that we're going to be holding here at the office before the season. But so there really isn't very many announcements. If you haven't heard it yet, then you probably aren't going to listen to me now. But thank you for being responsive and for checking your Slack and for sending in documents and housing forms and driver's license stuff. Like that stuff's important, and we're going to be starting that again for the people starting in May. So keep your eyes out. But tonight we have a special guest, and his name is David Bushman, and he's from Bushman Accounting, and he is a CPA. He's come tonight to help educate us on how to maximize our tax benefits as independent contractors and sales reps. Specifically, has worked a lot and enjoys working with summer salespeople and independent contractors like yourselves who want to know the best way to handle the tax situation, the unique tax situation that we're in. So he's from Spanish Fork and lives in Spanish Fork now, and came out here for us right after the tax deadline. So if he starts talking gibberish, you'll know why. His brain is a little scrambled probably after all that. But huge that he came in the busiest time of the year for us. So I'm going to turn the time over to him, and let's give him a big hand. Here he is.
So feel free to ask comments along the way. I'm very much a conversationalist. So if you have a question or comment, or on Zoom as well, if you want to put something in the chat and have a question, at some point we'll have Theron or someone look at it and we can try and address it as well. They may write some stuff on the board. I don't know. I'm just that kind of person. But also, yeah, if you have any questions, let me know. So Dave Bushman, I was a tax auditor for 5 years for the state of Utah. Audited at first was auditing oil companies, trucking companies, cigarettes, beer. I learned a lot about cigarettes more than I'd ever care to know, and things like that. But then I knew as that gave me time after I got my master's degree to study for the CPA exam and things. I knew that wasn't going to be my cup of tea kind of thing. I knew auditing wasn't my cup of tea because I don't know. As I would go and meet with, especially truck drivers, and I learn about their business, it was natural for me to start talking to them about what they can do to improve, increase profitability, things like that. And several auditors mentioned to me that I should start charging for all the consulting work that I would do while I was auditing people. And so it was natural for me not to stay as a tax auditor. So I did that for 5 years. That got me through the recession. And then afterwards, worked for a CPA firm in Murray for 2 years. I was the only other CPA. The other guy was approaching 70, so I was like, "Oh, this is perfect. It's a perfect buyout opportunity and things." And it quickly became apparent to me he was planning on dying in the chair. So I was like, "All right, I'll go start my own firm." So I was 6 or 7 years ago, started my own firm, and haven't looked back since. It was great. I really appreciated that. During tax season, it does get crazy though, because yeah, it was difficult getting ready for this at all because we've been working like 80-hour weeks, and I wanted my weekends to still at least spend time with my family if I could. And so then now we're here. And so I had one day to recoup. Okay. Well, yeah, so after the beer sales and all that, I went to corporate tax auditing and was a corporate tax auditor for a long time. That was the end of that story. Sorry, I forgot that part. So now with going out and doing summer sales, we've done a lot of tax returns for people in the same situation. Might be their first year, second year, third year, or I don't know how, whatever the consistency is, however long you guys stay. There's a lot of things that you can do to track some of your income and expenses. And I think eventually, for all you Zoom folks as well, everyone here as a tax organizer, the last page of that tax organizer that we'll send out to you guys has like a summary of business income and expenses. So eventually, in theory, you earn your revenue, you've got your sales, things like that, and the company will send you a 1099 for that, where hopefully that's all tracked in there. I guess, in theory, it should be correct, verify it, get with them before it's too late, if you have any corrections, things like that, but it should be all good to go. In theory, that would be your top number. And then after that, it's kind of up to you to start tracking those expenses and things. So as, and you guys could look at this even on like a Google sheet or something if you're on a recording or in front of a computer. Those expenses that you can go through. So some of them are like if you're spending advertising costs, your auto expenses, that's always the big one. You're driving out there, maybe you're taking your wife with you, you're taking 2 cars, things like that, is tracking those expenses, especially once you get, a lot of these expenses count as once you're outside of what they call your tax home, so 50 miles from your house. Because now you're going and renting a different location, you're working all outside of this. So tracking those mileage, the miles for the whole year, but then also what could be considered business mileage as well. Let's see, some of the other things, any subscriptions that you have to pay for, or maybe there's licensing that you guys have done. If you have to pay for your internet, I'm trying to think of just things of your utilities. Do you have any business insurance that you have to pay for? Legal and professional, so same thing, like you have to pay any business registration fees or formation fees. You paid your previous CPA or things like that, those can be written off. Meals could be, there's a lot of rules on that. Any office supplies that you buy, the rent that you pay, your telephone, so your cell phone bill, things like that, especially if you're paying for it. Any travel expenses that you have, and then any other things you can think of. And I always tell clients to kind of think of things that help them, what helped you make money, because that might be what steers you towards, that might be deductible, and looking towards those expenses and stuff. Ideally, if you do form a business with either a LLC or an S Corp, we'll talk about those options in a sec. It should have its own bank account where you're tracking the income and expenses inside of that bank account. So again, in theory, you go back at the end of the year and pull up that bank account, it's got all those expenses in there while you were out on location, and you put that together and create a nice little worksheet for Dave to do your taxes on, things like that. And so, really, I don't know, it seems complicated, but if you keep it simple, it's just a number, you come up with that final number where you can put that on a return. Let's see, what else? Okay, business formation. So one thing that I talked with Theron about was forming a business. Let's say when you first started doing this, you weren't sure what to make, you weren't sure what you wanted to do, so you just put your name, social security number down because that's what you got. If, let's say, eventually you do end up forming a business, there is a way you can transfer that over, even if the company still issues you a 1099 to your name and social security number, there's a way you can still transfer it over to your business. We can take care of that on your return. It's called nominee, and send that over to, let's say, your LLC or whatever. Another thought process with that is, let's say you have your income and expenses. At the end, if your net income, so income after expenses, is more than $30,000 to $40,000, usually we start talking to clients about making the S selection or forming an S Corp instead. And the reason for that is for self-employment tax. I don't know how much we want to get into it. We could do a little easy scenario. if we have time. And that thought process is eventually the advantage is that you have that. All right, let's write it down. We'll go through this a little bit. So let's say you end up, what's Theron, you know what the average rep-ish makes ish?
Oh, I would probably say somewhere in that 25 to 30.
Okay.
But I mean, it's all over the board.
Okay, so some could make more, some could make less. So let's do a $60,000 one just to make it a little bit more of a scenario. How long do most reps stay? Are they a couple of years and it grows as they stay, or?
Yeah, most people probably average 2 years.
Okay. So let's say on a normal just personal tax return, so that's your 1040, you have that on the Schedule C. And you'd have $60,000 of income. You'd pay your normal income tax, 12% federal, 5% state, so 17% income tax. And then on top of that, you would have 15% self-employment tax as well. So 20, what is that? 32%. When you form an LLC, this is kind of the little kicker here. The tax effect is nothing. It doesn't change anything. Everything still stays the same. It can even be a disregarded entity is what it's called when you're the sole member of that LLC, and it just goes right through on the same Schedule C, and everything would stay the same. The kicker is once you get to that $30,000 to $40,000 and you change over to an S corp, now you can kind of decide how much. We'll use Theron's name for example. How much Theron the employee versus Theron the owner can make, and kind of mix this up a little bit. And so you could potentially split that, let's say into, no, that's not only 30. 40, 20. So maybe the owner made 20,000, the employee made 40,000. And then that 15% now only applies to 40,000 rather than the full 60,000. So you can kind of trim down some of that employment tax. The key there though is you have to run it through payroll. So now your CPA bill goes up. An S corp has to file a tax return, your CPA bill goes up. And then, but you'll have those savings there. And that's why we usually wait a little bit to the $30,000 to $40,000 mark, because otherwise the CPA eats all the savings and it's just not worth it at that point. Because Dave makes money, but then you don't. And so that's the thought process there is making that S election and limiting some of your self-employment tax. Makes sense. Any questions so far?
What's that dollar
The,
Like for example, like
9,000. So it's 9,000 for the,
is that in the 32?
that's at the 15, that 15% right there is 9,000. That's how much self-employment tax.
Okay. So $9,000 in self-employment tax on 60,000.
Yep.
And then if you cut it down to 40,000, let's say.
If we cut it down to, only 40,000, then it's 6,000.
So 6,000.
So just right there, they say
60K at 40K. Yeah, you could get more aggressive depending on how you feel. It just has to be reasonable. So it's kind of a little subjective. I feel like that's just, I don't know, if you made 100,000, maybe put it at 50 or 60, but if you only made 30,000, it maybe just stays around 30 and doesn't save you a ton. That's why we don't do it. It doesn't quite make sense. And so, yes, right there, that's a $3,000 savings, things like that. I mean, these are little things because, like, I mean, I'll be honest, we fix a lot of TurboTax returns during the summer. TurboTax makes me a lot of money. And it's, people think, it's not that complicated. I'll just figure it out. Well, that one little thing just costs you $3,000 on TurboTax. And that's not their business. That's a formation issue, not a tax issue in a sense. And so they don't even mention it on any of their forms and stuff because that's not their job. And so think about it that way. One thing that I've also found is because a lot of summer sales guys are students, I should say gals as well, right? Guys and gals are also students as well. And those education credits a lot of times don't flow through. And that's, I don't know, because the software's fine, no offense, it's the user. Because you're data entering stuff in, maybe checking the right box or whatever, but you don't know what it's supposed to look like on the back end and what it looks like coming out. And so they'll, a lot of times I have, especially students, that's a SaaS one, because they only make, maybe 20, 30,000 a year. and then they've messed up their taxes and maybe a lot more, shaking your head.
Oh, no, way less.
Oh,
Yeah.
less.
Oh, Mom, I have a friend of mine who works and she made $6,000 this last year. I'm like,
Yeah.
that's crazy.
So, and you never just know, because I had one, this is one of my like favorite stories of all time. And it's funny, it's for a student, they only making 10,000 a year, it was a married couple, and they missed their education credits. He's like, I know I put those in. Like, he's like, I know enough, I'm a smart guy. I put them in and it wasn't on the return. And so when it came out, so we fixed the last 3 years plus the current year, and we got him a $10,000 refund altogether. He's like, dude, that's how much I made last year. And it was all tax-free money that I got him, $10,000. And so little things like that, where he just didn't know that TurboTax was costing him $10,000. You know, and so I shouldn't rip on TurboTax. There's other ones too. But it's just the easiest one.
Hey, Dave?
Yeah.
You mentioned the S corp, but what's the benefit of having an LLC, and at what point is that valuable?
So let's go through this, let's make a little chart here. So really, because like on an LLC, because like I was saying before, you have a Schedule C, that's just when it's on your 1040. So an LLC, and then you have an S corp. The LLC really, especially when it's a sole member, and just a disregarded entity, a lot of times you have an LLC in formation, like legalese form, but it ends up just being formed like that and just filed on that S corp. So a lot of times an LLC is a legal concept, not a tax concept. And so a lot of people think, oh, I formed an LLC so I can write everything off. I'm like, writing it off, you could have done that still on your Schedule C because it's probably gonna end up there anyway. And so, yeah, for the most part, especially when it's a single member, forming an LLC is that legal concept, not necessarily tax concept. When your taxes will change, that's when you switch over to an S corp. Anything to add on that?
Yeah, I actually have one thing to say. So, by the way, I'm a CPA too, so I'm not just.
So,
some
yeah,
random
Lee's
person.
what got me into this.
Yeah, he's the lucky guy. So, so for you guys going out for the summer and you have no idea what you're gonna make, I would suggest just setting up the LLC with just a one member. Because if you end up not making much, it's not gonna hurt anything. We're gonna issue your 1099 to you as the LLC person. And you're good to go, no big deal, it appears on that Schedule C. But if you start making some good money out there, we can make the LLC become an S corporation later in the year. So if you at least set up the LLC, single member, then at least you're like hooked up for the summer. And then if you start making money, then as the CPA, he goes, okay, let's file this 2553, this election to go, let's be an S corp. And now we'll run the payrolls, we'll catch you up for the year, and now you save on all that tax.
Yeah.
So anyway, just to kind of throw all that into one big.
It does give you a little jump start.
So let's say I want to form an LLC. What does it look, what am I looking at paying? I understand maybe you don't do that, but what does it typically cost to get an LLC?
Yeah, so usually you can do it, you know,
$75. I filed one this year.
yeah, it's for the state registration.
It's
usually.
like
Do it yourself,
Yeah, if you do
Yeah.
it yourself, it's like $75 total, and I think $20 for the actual setup, and then the additional whatever is the
22 and
state.
48.
Yeah.
Is there like a website or something you go to? that-
Yeah, you can do it on, like in Utah, there's the Utah TAP website, and you can just go set it up. It's pretty easy. The only hiccup that I find people do is they'll sign up for a payroll account, they'll sign up for a sales tax account, they'll sign up for all these other accounts. So I'm like, okay, you got 4 returns to file, and you've got all this, and they're like, what? And I'm like, just sign up for a normal account. Don't do all the extras.
Yeah, yeah. So
You
you just
know,
gotta go slow and then.
yeah.
it's-
And I mean, it'll take you a couple hours. I mean, some of the ones that I've done, it takes me like 45 minutes, but I know the questions and stuff. But yeah, the formation is about $70. You could do legal Zoom and things, but sometimes they also get you into, oh, now you need all this, and you need that. And you're like, yeah, you don't really. And so I don't, I'd just be careful. Don't get too much more than you need, because really, like Lee was saying, you're getting that EIN, because then if you end up making more than that. So here, the threshold that we kind of discussed was 30 to 40K-ish. That's around. Is that what you usually recommend?
Yeah, I do the exact same.
Okay.
Mhm.
Because otherwise it's just, the CPA is too expensive.
Yeah. It's not worth it.
Because then you
The
gotta file
cost.
separate tax return.
Yeah.
And things like that.
The EIN is that kind of like your, I guess for people that aren't quite familiar, that's like your social security number, but for your business.
Yeah. Yeah, they
Not
got TINs or EINs, yeah. Yep, and so that's your LLC's social security number. And then if that's already created, you've already got the jump start, we can just make the 2553 and say that you intended to be an S corp from the beginning and do that. Another little thing we talked about is payroll tools, right? An S corp, you're supposed to run payroll. And so again, there are online sites that you can do that on. There's some that are like $15 a month. They're pretty cheap. You do get what you pay for, you know, if you gotta file stuff and there's an issue or whatever, you're kind of on your own sometimes, but there are others that can help you a little more. They basically a little bit more expensive. We do run payroll in our office. It's not as cheap as the online that you do it yourselfers, obviously. But then you know that we're taking care of it, we're watching it. Like that reasonable compensation we talked about, we can look at that at the end of the year and say, okay, what is reasonable? Let's adjust it. I've had clients before where I made the S selection. It was an attorney. I made the S selection and ran my payroll and everything. And I was like, why'd you pay yourself $150,000 on a W-2? I'm like, because that's reasonable. I'm like, your business only made like 160. I'm like, so the whole point of everything, why you did all this, you paid it all. And that 15%, you paid it all. And that was not the right move. And that's the problem with attorneys. They always think they know everything. I have an attorney, good friend, I joke with him that the reason why only attorneys are in the legislature and the reason why they do it in the spring is so that no good CPAs can be in the legislature. Okay, go ahead.
Yeah, I just had a question about the payroll thing. So we're gonna try and qualify for a house this year. And so would it be more beneficial to add more money onto the payroll?
Good question.
Because that will affect how much you made, is that right?
Not really, but we'll see. So it kind of depends. So the question was, just in case the microphone didn't pick up, on applying for loans and things like that, doing bank financing, will the payroll help you? If the underwriter doesn't know what they're doing, yes, it will help you to run payroll. And that's the issue we run into all the time is, you know, because we'll have say someone makes 150,000 a year, we just run a $50,000 payroll. And they're like, oh yeah, you don't qualify for the loan. Like, there's another 150,000 on this return, go look at it. And they don't quite get that sometimes. So the underwriter has to understand what's going on and be familiar with business and things like that. One issue that can come up is usually a financial institution wants to see a 2-year history on self-employment income. And so it may not work the first year.
Yes, that's what happened to us.
Yeah.
Last year was the first year, this year's the second year.
Yeah, so if they can.
I don't think it will help you qualify more just because it's on the W-2.
Okay.
I still
It
think
shouldn't, yes.
Yeah, I don't think it will.
Yeah.
Typically, but
And really, because it's the same income, if you think about it, that guy made 200,000, he put 50 on a W-2, 150 on a K-1, it's still the same 200,000, but he wouldn't qualify. And that was a little bit lower, reasonable company.
Does that take out of like the taxable income though? Like if you add less money to payroll, is that less taxable income?
So what it'll do, because instead of left-handed, I realize it's
just
bad
say
for
you were
accounting.
like way on the wrong side of that board.
Because all accounts are creative, so they have left-handed. Are you left-handed?
Yeah, I'm right-handed.
You
thank
are. Well, they say
Like
all
ultra
creative accounts are in jail
creative.
anyway, so. Supposedly it makes me a little more creative, but no, which is funny because I have 6 employees and most of them are left-handed.
Are you serious?
Yeah, and
None
so,
of mine are.
which is funny when I sit at other people's desks, I'm like, oh, this is a right-handed desk. Yeah, we have to finagle things
Oh,
around.
that's funny.
Sorry, you had some.
Okay, so I
I'll get
do
it.
know that if you have salary, like if you have a salary job, it does make it easier to qualify for a loan. That way you don't have to have the 2 years tax returns. Is there a way that you could pay yourself salary?
That's that W-2
That's
he's
what
talking
it
about.
is.
Yeah,
Oh,
because if it's an outside source, then they're like, oh, you're good. But if it's yourself paying you, then that can create the issue. Yeah. And so in that scenario, because we were talking about, let's do 100,000. You know, let's dream, guys, right? And it's easy on that. So if you have that 100,000 on an LLC, oh, that's a C. Like I was saying before, because now you'd have, let's say, you're going to be a little bit higher. Let's say 20% income tax. And so this is your income tax, and this is your self-employment tax. So even if you're an S corp, this is kind of what you're asking, right?
Yeah.
So even if you do, even if you're the S corp, you're still going to pay 20% on that 100,000. It's just now you're kind of choosing what's going to be subject to that if that makes sense.
Okay, so
So-
that 100,000 is still counted as income.
Yeah,
On
so-
your tax return.
Yeah, because it's gonna be split up either between the owner and what's your name?
Andrew.
Andrew.
Yeah, Andrew.
So Andrew, the W-2, the employee, or Andrew, the owner who gets a K-1.
Okay.
So it's still gonna be the same 100,000. It just depends on how it's gonna come across.
That makes sense.
Yeah. A common misconception on K1s is, so in order to file, like to get a K1, so on an LLC, if you did have like partners, so we may not qualify in this scenario, but you file a 1065 return, which gives you a Schedule K, and then that K1 is, that K is split between the owners, and each owner gets a K1. So I have a lot of business owners that will always call me and say, just send me the K1. I'm like, well, you need the 1065 to get the K to get the K1s. Well, just send me the K1. Gotta go through the process. We gotta actually file the return to get it there. And so, but that won't apply if you have just that sole member and things. But that's more of a life lesson thing.
Got a Zoom question for you.
Okay.
So this is Garrett Farragher. He says, assuming you have the S corp set up, is there a good rule of thumb for determining the proper employee wage amount for yourself to safely minimize your self-employment tax?
All right, so figuring out that scenario, okay, so let's say. Let me just check. Can't stand for it.
And is there such thing as it being too low?
Yes.
Yes,
Okay, so that's what he
So-
wants to know.
for instance, I had a client who made 300,000 and only did a $50,000 W-2. I was like, that's gonna be too low, man. We got audited. And that's really what kicked off the audit, which opened up a whole other can of worms, because he's a business owner, has like 7 different entities, and I was like, oh my gosh, dude, you should have just paid yourself something more reasonable. And so there's some caps as well. So Social Security caps out, now it's 142,000. At the time it was 137 when we were going through this audit. And so the IRS said, we want to go the full 137 and then we'll stop. I was like, well, we want to go to 100,000 and stop. And we ended up settling at 100,000. But so we got away with 37,000 at 15%. But otherwise, I mean, and part of it what's helps is he has assistants and things like that. So they weren't going to go after the full 300,000, but they were going to try and push it. And I've noticed that with the IRS and those agents is they'll push it to the top of the Social Security, because then after that it drops to 2.9%. So it doesn't matter so much as well. They're not going to get that much money out of you after that.
So the IRS wants your wage really high, but we want it really low.
Yeah.
And so that's why they talk about like, it's gotta be reasonable, like what are we both gonna not fight about? That's what they're trying to, and there's no number.
Yeah, it's really hard, because if you only made 30,000, you probably got to issue a $30,000 W-2. If you made 50, you probably get away with the 30. If you made 70, you probably got to do 35, 40-ish. If you make 100, you probably got to do 50, 50, 60 maybe. I don't know, it's kind of a range. I usually don't go above 100 unless it's like a doctor or an attorney, because I figure any job's reasonable to 100-ish. You could probably fudge your way through the audit at that point. And so that's kind of my thought process there.
This is coming from a previous auditor.
Yes.
I like that. I like that. I like that.
That's one benefit. I feel like I know when to push it and when not to, and when to be like, if you're gonna get in the gray area, let's go over here and not over here, kind of thing. Yeah, it's that auditing experience. So that's a lot of the formation stuff. And yeah, a lot of it is just forming that LLC to have that EIN. So you can make that selection if you end up making too much money, which I think everyone would be happy if they had that problem. End up making too much money by accident. What else? Anything else in kind of this area? Something else that a lot of questions come up on is auto expenses. I'm just going to cover a little bit. So there's 2 different ways to do auto. One's called the actual method. The other one is the mileage. So don't let that confuse you. Either way, you have to track your mileage.
Either way.
Either way. So no matter what. I thought she was correcting my grammar. That's what.
No, either way, we have.
Either way. So if like an average person drives about 12,000 miles a year. And if you think, 5,000 of it was business or whatever, Let's do 6. We're gonna go easy math here. 6,000 of business. So that's 50%. So if you're from Spanish Fork, like I am, if you're familiar with Utah County, we're gonna buy, that $80,000 Duramax, or at that point you might get 100 or whatever. So you're gonna buy this big truck or something that gets you gets you around town, whatever. So for simplicity, again, we're gonna do 100,000, but I hope you're not buying $100,000. Which, by the way, most of the clients that drive up in the $100,000 cars should not be driving $100,000 cars. Just
This
so you're
I
all
was
aware.
actually gonna have you talk about this, because I've had sales reps that go out and they come home with Lamborghinis, and I'm like, the IRS is never gonna pass off on a Lamborghini on your tax return.
Yeah.
So,
Well, what they don't think about is that 15%. And then like, wait, I owe 50 grand in taxes because they made,
Yeah.
must have been one of those reps that made a ton of money.
yeah,
And they're like, I don't have 50 grand. I'm like, go sell your,
yeah.
yeah. One of my clients had a $250,000. It was the Mercedes AMG something. It was super nice. Like, I love that car. But he owed the IRS $750,000. I was like, dude, you cannot afford that car. Most doctors drive nice Beamers and Mercedes. Trust me, they might have the revenue, but they still own a lot of student debt. And things where they've got 2 or 3 mortgages essentially. And I'm like, you can't afford it. So all this stuff's done. I don't know, maybe that's the conservative accountant in me where I pinch my pennies and stuff. But yeah, don't go buy $100,000. Okay, so with this scenario, so $100,000, they give you or 5 years or 7 years. These distracted them. They give you several years to depreciate that to get like a return of your capital. And so it's called depreciation. So my math should have my nerdy numbers with me already. So you're gonna get like a $14,000 deduction each year. There are bonus rules. Is it 7 years in cars? Is it 5?
It's 5. If it's 100,000, it might be, no, I would press it.
Okay, let's do 5. Okay, so you're gonna get a $20,000 vehicle deduction. There are bonus rules. There's things called 179 as well. People still ask me about 179, which is funny because it basically went away in 2018 with the new tax laws. So with bonus rules, usually you can take about 100,000 of that car if you wanted to, unless it's a really big year. Maybe that is the case sometimes. But then when you go to sell that car, you also have to claim the gain. So let's say you drive it for 3 years and you trade it back in for 60,000. You're gonna have so you're gonna get $100,000, we'll call it expense here. But then you're gonna have a big gain coming down the line, unless you keep that car for 20 years, or I don't know, it's not the case anymore, right? Because 20 years old are going up in value, but if the world was normal again. And so that's something to keep track of. Eventually you may have that gain come back. But I guess in theory, you buy another truck or whatever, and you offset it, and you play the game. Eventually it does catch up to you if you play that game. The other thought is now you're writing off all of your other expenses. So your oil changes, tires, wrecks, whatever you have, you're writing all that off. But remember, you were only driving that 50% for business. So whatever number that is, divided by 2. Divide by 2, divide by 2. Because you're only going to get half of those expenses. If it was 30%, you get 30%. If it's 75%, you get 75 of the expenses. So either way, you still have to track that mileage and figure out what your actual expenses were for that vehicle, and then you take a portion of it depending on your mileage on that percentage. The other route is called the standard mileage rate, which last year was 56 cents a mile. This year, I haven't looked it up yet because we just got done 2 days ago. So it's usually somewhere around 57.
58 and a half this year.
Oh, okay. 58.5. Usually I learn it from clients because they know what's so usually it's right around 56 to 58, depending on it's usually determined like 3 or 4 years ago. So it's interesting when gas prices go down, sometimes it's really high, or vice versa, because it has like a 3-4 year line to it. And so, and that's just straight up. So if you had 6,000 miles, you get a $3,500 deduction or whatever, just based on that. 58 cents times 6,000, and you're done. That's it.
If you're writing off your miles, then you can't write off your gas, right?
Correct, yeah, it's either one or the other, not both. And so your gas and oil and stuff like that is all over here. Yeah. And so, which is hard, because a lot of clients do that where they're like, well, I filled up the gas tank when I went and did this. I was like, yeah, but all that mileage was somewhere else. That's why they don't do it that way, because yeah, it can get too crazy.
So when does it make sense, like, if I'm using a personal car to drive out and to work, does it make more sense to use mileage versus, because, yeah, I guess, when does it make sense to use actual versus the mileage?
Yeah, so on our business worksheet, and again, on people on Zoom, we'll send this out to you guys. This goes over, we have a business mileage section. Little asterisk on there should be written or logged. It technically asks us if this is written, and we always just say yes, because we assume if we get audited, you've got it. Most clients don't, but we assume you do. Not your problem, not. We'll help you defend it as much as possible. So on that, it asks for the year, make, and model, the date you purchased it, the purchase price, the total miles you drove, the business miles you drove, and how long you plan on keeping that vehicle. One thing that we're gonna add for next year is how many miles do you think you're gonna put on that vehicle? As we go through some of that question, because it kind of depends on how expensive was the vehicle and how long do you plan on driving it. Which is also kind of a catch-22 as well, because if you bought a $2,000 98 Accord, you might have more expenses than we thought, but that's the thought process is, did you buy a $100,000 truck or did you buy a normal $20,000 car? Kind of thing.
Does the car have to be new for it to like depreciate?
No,
No.
no.
Okay,
New
so
to you.
you could buy like an old car, new to us.
Yeah. So for a long time when I started Bushman accounting, I drove a beater 98 Honda Accord. That was my scenario I gave you. And I figured out it cost me 11 cents a mile to drive that car over the life of the car. I was making bank on that thing. And then finally my mom said, if you weren't my son and you were a CPA and rolled up in that car, I wouldn't do business with you. And she said I had to buy a new car. And so. And so.
The mileage, like he was saying, though, it has a lot to do with the type of vehicle you drive, because if you're driving a big truck, then you're probably more on the
It might,
actual
yeah.
side, but if you're driving an economic car, then the mileage side will probably. So
Yeah.
he's given you the example on your sheet to say, we're gonna look at both scenarios, which is the bigger benefit for you.
I would say probably 80, maybe even 80+% of our clients are on the mileage. Because it's way simpler. Most people don't have $100,000 trucks or things like that. And so, I don't know, this is where we usually go. I would say most likely in your guys' income range, students or whatever, you're probably in this one as well. But you never know. You could come in with that Lambo and
Yeah.
we see what we can do. Yeah. The problem is the guys that have the Lambos or the Mercedes AMGs have 5 cars. And then how do you mix that up now?
Well,
Because they don't drive any of them for business.
He let me drive the Lambo, so I was okay with this deduction. I was
Yeah.
like, well, we're good with this, because I got to drive it.
Yeah. I've gotten to drive the Teslas, the Corvettes, the
We're
AMGs,
good.
yeah.
If you have a luxury car and technically you're self-employed, because like we're building a business, can't you write it off as like a recruiting type of incentive? Because I know
So-
that that is an option, it's kind of loophole, it's a little shady, but.
So I have a lot of people do this where the influencers, because they have their cars and they Instagram and do all that stuff. So let me tell you how it is, because then they wrap it as well. All right. So let me tell you how much you can write off on, oh, I spelled wrong. On your car. It's still spelled wrong. The wrap is deductible, and then everything else goes there.
The wrap.
The
as
wrap
in,
is deductible and that's it?
like
And
the,
then you just fall under all these basic
Well,
rules.
that's why there's so many wrapped cars here, it's all those sales pros.
So, I mean, you spend $1,000 to wrap your car, so you get to write off as an advertising expense, and everything else follows the same. There's nothing special. So a lot of the influencers think they're like, oh no, because I do this, and when I go to the grocery store, I'm advertising everything, like, it falls under these same two, it's either this one or that one, pick one. And they're like, but my company says I can do this and everything, I'm like, do that one or that one, pick one. And, I mean, we go through the calculation. Yeah, other than that, you just get to write off the $1,000 wrap.
Okay.
And so,
Dave, you worked with a lot of people in this scenario, right? A lot of summer salespeople. What is the one thing that you typically see them get wrong or not do when it comes to this?
yeah, that was the next one, actually. I'm glad you brought that up. So we're gonna, in my opinion, we're gonna talk about home office, that's the abbreviation for home office, and then travel as well. So, because since you're outside your tax home, you've got rent that you normally wouldn't have. I mean, in theory, you maybe would, but let's say you could have lived at home and things like that. So now with this home office calculation, you've got rent, utilities, because you're not buying the place, you don't have mortgage interest, things like that. What else? You may have to have renter's insurance with it.
Internet.
Yeah, your internet, your telephone, and I'm gonna put those down here.
And so with us, there's gonna be a portion of this that they pay themselves, internet, et cetera. And then we have a housing deduction that we do it's a flat rate that we just take out of their check.
Okay.
And then they can earn some of it back in a housing bonus, but at the end of the year, they'll know how much money we took from them for housing. So it's a number we provide them.
Is it included in the 1099?
It's a deduction before.
Yeah, so
Oh, but it
throughout,
is before.
yeah,
Okay.
so throughout the year, so we'll end up paying them their commissions and then we take out the rent before we calculate that.
Okay. So, because this is some of the life lessons that we talked about, this is
Yeah.
life class, is because I have a lot of, so not from this company, a lot of guys that'll get their 1099s and it's got the full amount in there, and they're like, oh yeah, because we gave you the rent deduction. Well, they include the 600 a month or whatever it was they got into the 1099. So I'm like, well, that means you still need to write off the rent to actually get the deduction. And so that's good that you guys compensate, if I understood you right, you're compensating.
So the company pays for the apartment. A
Okay.
portion of that we take back from them at the end. If, depending on how much that particular apartment was and how it compares to kind of our standard amount that we provide in that housing bonus. But
Okay.
so some of it they get in a bonus, and if they don't earn the bonus, then they pay for it.
Okay, so I keep track of just what came out of your pocket. And that'll be really your guide. And maybe you did pay, 600 a month for rent, but then these guys reimbursed you for X amount of dollars. So you minus X, and it would equal what finally came out of your pocket kind of thing. And that's what it would work. And really, because in a home office, you'd have a portion that was exclusive for your house, things like that. But since you are traveling, you're outside your normal tax home, all of this would be deductible. We would just write it off on the business. And so, yeah, you just want to make sure the things that you spent, that you went out of your pocket that you spent, get deducted. The reason why I put a little separation here is because sometimes internet is probably going to be stuck in there. But even when we have the home office calculation, I usually have a business pay for the internet and telephone regardless, 100%. Because otherwise, in the home office calculation, it goes through just like the square footage of your house. So let's say your office is 120 square feet, your house is 4,000 square feet. You get a percentage, and then you get a percentage of your real estate taxes, your mortgage interest, percentage of utilities. Just like the auto expense, it's just the home office expense you can write off. And so,
Just keep track of all of those.
yeah, over the summer, keep track of anything that essentially you pay out, because it's helping you make money. That's the way to think of it. Did it help me make money? Oh yeah, I had to pay utilities. So I'm gonna probably at least address that with my tax preparer and see if that figured it off. Which is funny. So the guy with the $250,000 Mercedes, he built a new house. He was like, yeah, I got this new sweet office and it's huge. I don't know. I'm thinking of something, 250 square feet or whatever. I don't remember what it was. And he's like, but then now my house is 10,000 square feet. And I'm like, yeah, you basically don't get a home office deduction because that's nothing. You don't get hardly anything of it. And so I was like, yeah, that kind of worked against you. But hey, you got a 10,000 budget. 10,000 square foot house. So that's kind of one of the housing stuff. The other one with travel, this one is a little bit funky. And this one's a little bit tipping my hand as well, as where we really saved a lot of the summer guys' sales money, is per diem. Did I spell that right? One of those is the I, whichever one you decide. I know whichever way I type it, I always type it the wrong way. I learned that with apologize. There's only one P because I'm really not that sorry. That's how I remember how to spell that. I have to remember little words like that. Okay, so one of this is tracking the number of days that you are outside of your tax home. So the day you leave, that's your travel day. The day you come back is your travel day. It's, May 12th to October 1st or whatever it is. And so we go through and there's some really cool Google things that'll tell you how many days between dates.
And where you're at.
And it can, yes, it
Because if you
also,
move,
yeah, it can matter depending on where you're at. There's a high-low method, especially if you're in a really expensive area. You can get a really high rate or a really low rate. What they do is, let's say you're gone for 100 days. You can tell you like easy math. If I asked my staff, they would know what the average high-low rate is. It's like $67.
So like the Conn's rate? I thought it was 57. I don't know.
Maybe 57. We'll go with 57.
Okay.
If I ask my main,
The last time I looked it was that, but if I could be wrong.
I don't look it up all the time. My staff does. So whatever the rate is, so you'd end up with a $5,700 deduction for meals and incidental expenses, is what they call it. So it's just kind of we assume you're outside your tax home, you're gonna have expenses and stuff like that. So we'll give you a per diem rate that you can write off. Let's say, trying to think of an expense rate. If you're in LA or something, that rate could be, 75 or whatever, and then you could get a $7,500 reduction. I don't imagine Arkansas is super expensive. It is Kansas, but you never know. Maybe, and where's the other?
We have reps in Virginia, Maryland, Oregon, Washington.
So some of those could be expensive, yeah, especially depending on where you're at, some Maryland areas and stuff.
What's it called? The high-low?
It's per diem is the concept, and then what's it called? The high-low method. I think that's what it's
I
called.
thought they called it the CONUS rate, CONS rate, but it's if you Google government per diem rates or something.
Yeah,
like
government
that,
per diem rates.
it'll pull up a
And
website.
it's not for a city or is it for a
It's-
state?
It's per city.
There is a table for cities. They also just have an average number. So if you do travel around,
It's GSA.gov.
yeah. Because let's say you are in like 5 different states out back east and things, that rate would be all over the place. And so rather than, it's a lot, because sometimes you're only there for 2 days, 3 days, and that could be a lot of math. And so we may just give you that average number and come up with that. So in those scenarios, so let's say you're one of the reps, you make $50,000, whatever, and now we're writing off 10% of your income, 5,700 at 12%, whatever your income tax rate is. So what would that be? $684. That's actual tax dollars that you would have gotten taxed on, that now we've written off. That one right there is like the nail in the coffin for TurboTax stuff. That one's like my secret weapon for the summer sales guys. So I totally tip my hand, but TurboTax just doesn't bring that up because it's just not in their thought process. And even a lot of tax preparers, enrolled agents, or CPAs don't bring it up at all if they just aren't familiar with the summer sales type industry and writing off when you're temporarily outside your tax home. And that's the thing, is because you're on temporary assignment for 6 months or X amount of days and things like that. And so that's why it works. Otherwise, if you move to Arkansas and you get a job with Walmart and you never come back, that could be an issue. And you may not qualify for this anymore.
Yeah, so jump back to the loan stuff, that's bad for getting a loan, right?
Yes,
It ends up on your meal.
it's a deduction.
Oh, 'cause
so
it is
50%
50%, I didn't-
income.
Yeah, it does lower your income. I totally forgot about this last piece because it is a meals incident, so it's only 50%. So there is more calculation to it, kind of thing.
Unless it's this year,
The 21 year.
because it's 100% this year.
Yeah. 2021 was an enigma. There were so many different rules in 20 and 21 that don't exist now. And so I feel bad for if you haven't filed in a long time. So 2017 had a tax law. 2018 had all different tax rules. 2020 had all different rules because of COVID. 2021 had all different tax rules. Then we go back to where we're at now, 2022. All of this gets erased in 2024. And we go back to what it was in 2017.
Unless they extend it.
Unless they extend.
Oh my gosh.
Yeah, so we have clients, I'd say we do a couple of these a year where they're like, hey, can you file 10 years worth of taxes for me? I've never filed. And I'm like, you are gonna pay through the nose on my bill because I have to know 6 different tax codes in order to do your 10 years worth of taxes. Good luck, buddy. So anyway, don't do that to yourself. Just file.
That's a good segue to as we wrap up here, my last question.
Oh, yeah, sorry, we've gone way
No,
over.
good, it's been great. The question is, if they are looking for some help with their taxes, or with creating an LLC, where should they go? Can they reach out to you? Are you able to help them with both of those?
We can help them with the tax side. We can figure out something with the business formation.
Or at least refer them
yeah.
to like someone, and then they come back to you once that's done. And
Yeah, we can find
get
something.
the taxes rolling.
So my info,
And I'll send this out. as well.
yeah. You want just like an email address? I can give you my phone number. This is my office number. So 801-901-7061, and then David at Bushman Accounting. Or look us up on bushmanaccounting.com. I'm on there. My history's on there a little bit. I have a cool video of me looking amazing and interesting so that you don't think I'm just this nerdy accountant that I am. So I purposely am in a side-by-side riding up in the mountains and stuff. That was the goal of that video, is to make me not look totally nerdy. So
David, I have one thing I want you to talk about commingling in a business bank account and that kind of thing.
okay, so this is actually going back to my auditor days. Let's say, what's your name?
Kayla.
Kayla. I'm gonna come audit Kayla, back to my auditor days. And I say, okay, Kayla, I want to see all your business transactions. I've got your tax return. Now let's look at your personal finances or your business finances, and let's figure it out. As a tax auditor, never, ever, ever did they ever match. Did their books match their tax return? Where they could pull up a spreadsheet or things that showed me what was on their tax return, be like, okay, you put $367 in meals. Let's see what makes up that $367. They could never get every number to match ever. As a CPA, picking up clients, I mean, we picked up thousands and thousands of clients. I have never, ever, ever had a new client match their books with their tax return, ever. So what does that tell you? Is there's an issue with sending good information to your CPA, or your CPA making changes and not sending it back to you, things like that. And just communicating and just figuring out or keeping your records. In theory, the IRS can go back within statute within 3 years. If they think it's more than a 25% adjustment, then they can go back 7 years plus the current year. So really got to keep your records for 8 years. If they think it's fraud, they can go back forever. One thing to keep in mind, so if you buy a house, you keep it for 20 years, you sell it, you have to have the records from when you bought it to when you sold it plus 8 years. So grandma's house that she's lived in for 50 years, she should have that original purchase document. Because otherwise, after 8 years or whatever, they come audit you, maybe the house isn't the best, but some type of business equipment, they come audit you after 6 years, think it's more than 25% adjustment, they'll say, well, prove that you bought it for X amount of dollars. You got to have that beginning settlement statement in order to prove that. And so that's an issue. What was your original question? I totally.
Sorry, the commingling.
Commingling,
Running
yes.
all the business through the personal and personal.
And so what happens was when you're auditing that, the records don't match. Well, now they say, okay, well, it's on my credit card statement. Well, one, credit card statements don't work. They only work for balances and things like that. We need the actual receipt, because we say, well, what did you buy at Walmart? You could have bought groceries for all I care. I want to see the receipt. And then if it is mixed with business and personal, they're going to say, well, now as an auditor, we're kind of just forced to audit you personally as well, because everything's just mixed all together, and we just got to look at your whole life now. If you would have kept it in the business and done it where you had an LLC, that's one other benefit. We forgot that. Another benefit of an LLC is now you can form a separate bank account at the bank. All your business transactions go through their income and expenses, and that's what they audit, and they stay within their lane. Otherwise, if you commingle it, then that gives them permission to start looking at everything. And so that's a good thing.
But commingling just means like, I
Yeah.
paid for my personal over in my business and I paid for business over my personal, like you're like mixing all
Yeah,
your stuff.
You're just mixing personal and business, and there's no delineation. If you get audited, then there's going to be no delineation as well. They're going to go after everything.
Question about commingling, this kind of gets into properties and investment properties and things like that. Should you have a different LLC or business account for each property that you have?
Yes, in a sense, because it's not necessarily for a tax reason, it's for a legal reason.
That way I know they can't sue
So-
you. Like, that way they can't come after all your other assets.
Yeah, because you're gonna have like you as a person here, and then you'll have maybe some, if we're getting into property management, some property management company here, and then each different property would be here, because otherwise, let's say you have 4 different properties in here and Johnny is riding his bike and breaks a leg on a trench that you knew existed, and now he sues you, he's gonna go for every single thing inside of that bubble. And if all 4 properties are in there, in theory, you can go after all 4. And so, in theory, you wanna keep them all separate, not for tax reasons, or for,
Okay, going off that again, I guess I would probably do the same thing. If let's say because we have an escort. So we have an escort, but we're kind of funneling different things under it. So like if I was doing real estate, not just summer sales, do I need to have a separate escort or LLC for my real estate business?
so if we expand this a little bit. We'll make you up here. Usually the S corp will manage any operating businesses, which is summer sales, or you own some company and people work for you, or you're doing real estate transactions, things like that, but not the real estate themselves. Usually, because inside of an S corp, there's something, inside any business, there's something called basis. And if you have loans on an S corp, that's not your money, that's the bank's money, and you can't take it out. And so I have this issue with contractors sometimes with S corps, where they say, oh yeah, I went and bought my $100,000 truck and a $70,000 excavator and a mini and a skid steer and things like that. And I'm like, well, you didn't buy it, the bank bought it. They're like, well, yeah, but like, so then you don't get basis in it. Any money you take out of the business is now the bank's money, and you're gonna get taxed on it on an S corp. So you gotta be careful when you have big loans in here. And that's why real estate usually doesn't go inside of here, because there's too big of loans and there's issues.
But like a separate business, like if I'm a realtor and then my husband does pest control sales and we share an escort.
If you're a realtor, there are different rules.
Okay.
Yeah, that opens another thing, because now a lot of these loss carry forwards and different things can change, because now it's your business. And so it can,
But the rule of thumb is if you have an LLC, have a dedicated bank account for what
Yes.
you do in that LLC.
yeah, that's what we're getting at is, don't commingle, what they call it. You'll pierce the corporate veil. That's another terminology you'll hear. Where I asked an attorney one time, I said, if I mix just my credit card, I have separate bank accounts, but I have the same credit card for things. Will they keep it separate? And he's like, it may matter, but it's gonna come up. And that's the thing, is you don't want it to come up. I was like, okay, that's the kicker right there. And so that was from an attorney, just saying, you just don't want it to come up, and it will if it's commingled. So, yeah. Anything else? Anything else on this, Lee? Any corrections?
Receipts too, though, you did
Oh.
kind of mention that, so they want physical receipts, a credit card statement will not work, a bank statement will not work in an audit.
Yes.
They want an actual receipt, they don't care if it's scanned. It
Yeah.
has to be the actual receipt.
And in the sense of it will not work of if we're getting down to it kind of thing.
Well, it depends on the auditor.
Yeah, it depends on the auditor. There are a lot of new auditors at the IRS. Oh man, I had 3 clients go through audits this year, and every single one of them threw the book at me on every single audit. I was like, hey, you guys are jerks. How long you been there? And they're like, 4 months. I'm like, that's why. The one that 2 years ago, the auditor me had been there 6 years. Dude, I negotiated all over the heck with that guy, and we saved the client so much money on that audit. These guys didn't budge a bit. Yeah, that's really, I kind of consider receipts plan B, because plan A is like letters. We try and just put it to bed. Plan B is we go through the books with the auditor. We try and get that to bed. Plan C is we're going through statements, saying, no, we did a good job in bookkeeping. Don't keep going. Plan D is receipts. We're probably screwed anyway. You better have them. And I don't ask for them when I prepare the taxes a lot of times, because I'm like, I assume you have the receipts. I mean, I go off the transactions and things like that. But yeah, you better just have them, because if it gets to that, we're probably screwed anyway. So you better have.
One thing just I didn't know, I don't know a lot about accounting, but I went through a lot of my life just thinking that my credit card statement was enough. And you get, when you're going through life, most people don't even want to give you receipts. They're asked, do you need a receipt? You're like, nah. But I'm learning now, but I mean, yeah, she said, I have to keep every receipt, receipt. I have to, she set me up a Dropbox, and so I just scan every receipt, but it's not easy keeping every receipt.
And what I do is I just say yes every time, put it in my back pocket, and in my closet, there's a spot that just builds and builds and builds, and I put the receipt right there. And then every once in a while I go through it and I just get all the January 2022 receipts, stick them in an envelope and just write January 2022, February 2022. You don't even have to organize it, just have it in the right month, because then if we go to the statements, and the auditor says, well, look at some of those, we'll pick some,
Find it, yeah.
and we'll pull it out.
Another thing nowadays is a lot of stores will give you the option to email a receipt. Always say yes. So that just gives you a record that's, you don't have to worry about the paper. You can always go search your email and find that later if you have to.
So what's interesting is I had one auditor call us on receipts as well, and I said that, because it was one of those 7-year audits, and I was like, they're gonna be all faded, and she's like, oh, look, I'll bet you they're there, and I was like, huh? And she said, it's the heat, so don't leave it in your pocket for a month, you know, wash your jeans periodically, but take them out and put them in the thing. I look back, and this was a eye-opening to me. I look back through my records, I was like, yeah, right, so I open it up, and I'm an accountant, so I have my receipts back to 1992. And I'm looking in there, and I did not realize I had that far back, by the way. And I went, and they were all there, every single one of them. And I was like, dang, they really don't fade if you, as long as you don't keep it in your back pocket, or don't keep it in the wallet, or whatever. Don't
Your
put heat
car
on it.
dashboard.
It's the heat that kills it. Yeah. And so if you're down in Arkansas, you know, get rid of it. Put it in a bin or something. But yeah, so in theory, those receipts will stay around. I was really surprised, and then I got rid of up to at least 2,000. So now I'm down back to 2,000. So.
Good question about like if we wanted to use you like fees, because there's probably like quarterly fees and then startup fees or whatever.
There can be, it kind of depends, and with inflation, it's a little hard to gauge now because things are changing, our software is going up, everything is going up. So as a general rule, as an office, we charge $135 an hour, which for a CPA firm, usually they're like $200, $250. I know some of the big, like if you're from here in Utah County, Squire and Hawkins are like easily $350 an hour. And so I don't know, I just remember being a college student and paying Squire because that's what my family used. Paul DeBry was one of the founders of Squire, and I paid $350 20 years ago and said, never again, I'm never gonna pay that much. But that was because I knew I was going into accounting and taxes. So I remember being a college student that I didn't want to pay that much. So, which is funny because now I'll tell you more about it. So usually as a firm on a personal return, most returns aren't cheaper than 300. You like a personal return, usually they're probably more, the average is like 500 to 600, 700-ish range. And then if they have a business and different side things, usually the business return starts at about 4 hours. So that puts it about $500 going forward. And that's why, because it can get a little pricey on some of the stuff. I erased it. That's why I have you wait till 30 to 40,000 before we do some of the switches, because it can get a little pricey. But if you run back through the numbers again, if you forget one thing, you miss it, that $3,000 adjustment that we talked about, that was $3,000. I'm now potentially paid for the next 5 years if you made one mistake on your, personal prepared return. That's kind of the risk there is, you try working on your car and risk, knocking the piston and now you got a $10,000 fix on it, kind of thing. So it just kind of depends. It's
Paying your account, this something.
Yeah, I think it really is, because again, we fix TurboTax returns all summer long. That's what we do is, hey, I tried to do this and couldn't get it right. And I'm like, yeah, you're supposed to do this, this, and this. And it surprises me how many times people tell me like, well, how am I supposed to know all this stuff? I'm like, that's why you hire a professional. You're not supposed to do. I mean, you can, but I've got 7 years of, I went to college for 7 years, and it took me 2 years to get my CPA license. And then I've been doing this for, another 10 years on top of that. And so, yeah, it's like being a doctor. You just know it now. And so, but, well, thanks guys. If you have any questions or anything, shoot me an email. We can help you out. If you're interested, let us know. We can always have a phone conversation, chat with you. I don't know, anything that ever comes up, let us know. So thanks guys.
Thanks, David.